All right, so today is Wednesday, October 21st, 11 a.m. section. Recording is on. What we're going to spend most of our time today is, now that we have gone through the second section of historical analysis, we are now going to move into the third section of the course, which is on the valuation model, the enterprise DCF model that we are going to do based on the converted Modigliani-Miller statements. So to that end, I posted a little while ago in the files folder. There's a folder called WMT, which has 2 Excel files that we're going to need in class today. And the important files is the Walmart start file. And essentially, what we're going to do in just a few minutes is, using that model, you're going to follow along, and we're going to create together a valuation model of Walmart. So we'll be doing that over the next several classes. You will be turning in pieces of that model, just showing that you're making progress, so that you're exactly building the model that we build together. And you're going to do this individually. And then when you finish, that is a reusable model, which will take us 2 weeks to value Walmart. It'll take us 10 minutes to do the next company. And your next group project will be using this model that you're building to do a valuation of CVS, which will be presented next month. So essentially, that's kind of where we're going next with the course. And we're going to get a little bit more technical and using Excel. Okay? So the other thing I wanted to mention as you're scrambling to get those files is that on Monday, just as a reminder, the CFO of Aetna, which is the CVS Health benefits company now, CFO, so it's a pretty senior guy, is going to be here between 12 p.m. and 1 p.m. to listen to EIC presentations that we had previously done. He said he was interested in hearing them, so we agreed on his schedule. That was the only time he was really available that worked in with our class, so he's going to be here from 12 to 1. So that means 2 things. One, our class next week, which will still be at 11, will be cut short because we're going to start with him at noon. And I'm inviting anybody in the 443 sections that are welcome to listen in. And 2, I am giving some people here the opportunity to make that presentation for extra credit. Okay. So if you are interested in making it, and I'll give those invitations in just a minute, let me know, because we'll coordinate on that, and you'll make a similar 10-minute presentation of your EIC to the CVS CFO, and then he'll be able to ask you questions and interact. And so if you're selected to make that presentation, you'll be representing the school, so I assume you'll do a good job. Again, you guys did a good job in your presentations, so just kind of repeating what you did. And then secondly, answering his questions. And so now that we spent more time on CVS, hopefully have a better understanding of what's going on with the company. But anyway, so we'll be doing that on Monday. Probably have about 3 groups present is what I'm planning for during that hour of time that he will be here with us. Okay, so that is just one other nuance that's coming up next Monday. Okay, questions about that? Or the valuation that we were about to do. All right, so just double checking here. But in this section, Team 6, you have one of the opportunities to present on Monday. So if you are interested, reach out to me separately to confirm, and then we'll have a follow-up conversation either at the end of this class or afterwards to talk more about that. But you guys did a great job in this section, and so you actually are one of the candidates to potentially present. So Team 6. All right. So let's talk about the Walmart valuation. So open up my file here. So the file that you want, it's called the valuation model WMT start.xlsx. And then there's a second file called WMT data. So let me go ahead and share my screen. Sorry, I was having trouble with the sharing here for some reason. All right, share screen. All right, so I'm going to start with the Excel file. There's two Excel files, right? But this is the Walmart valuation model, the start file that we are starting with. Make it a little bit bigger so you can see it. So the way that the model is structured that we are going to build is that you're not going to completely start from scratch in building the model. That I'm giving you some basics that are already in place. And then it's almost like you ever watch the cooking show where they give you the ingredients. We're going to take those ingredients, we're going to mix them and actually build the valuation model. So I'm going to help set the process up a little bit. So the way the model works, again, it works in a series of tabs that go from left to right. The first tab here is called the model data tab. And this is the historical data for a company, and again, mapped to Bloomberg. And so in this case, it's for Walmart, and it's 6 years of historical data, income statement, balance sheet, cash flow data, right? Now, one of the things that's very important in building a reusable valuation model that's actually relatively easy to use is you want data to come in a consistent format. So that way you can use the model again and again, no matter what the company is. So you need standardized data, right? The problem is even Bloomberg doesn't have standardized statements. They'll say they have standardized statements, but we've actually found out in this class that their standardized statements aren't really standardized. And so that becomes a challenge, right? So basically, in order to do the valuation, so I'm going to jump here to Bloomberg. Here's Walmart. Like we need under FA, we need historical income statements, right? And we need historical balance sheets. And I've just chosen 6 years arbitrarily of historical data for our model. But the problem is these statements, income and these subtabs, adjusted, GAAP, as reported, the adjusted data for Walmart is not necessarily the adjusted data for Pfizer. So they could have different rows. And that becomes a problem because we don't have a pure standardized income statement and we don't have a pure standardized balance sheet across the companies. So, and there's cash flow statement. So what I have done, and this is actually something you will do, is I have used the custom tab under FA to create a custom series of fields, which is in my model already saved. Which has the line items for the income statement, the line items for the balance sheet, and the line items of the statement of cash flow. So all the ingredients to build the statements are here as an FAA custom sheet that's saved for 6 years, right? Now, what's going to be very important is this essentially gives us the equivalent of a standardized template, because using this FA custom template, what we're going to do is we're going to export the data from Bloomberg in these rows, and I'll always know that row 2 is cost of revenue, and that basically I'll put that into Excel, and I'll use that model in Excel to help standardize my statements across the company. So anytime I switch from Walmart to CVS, as an example, then basically in this template, the Walmart data has now been replaced with CVS data, right? And then what we will then do is we'll export this data to Excel. This is the CVS data, but and it'll put it into an Excel template, and there is the exported data in Excel. That is something I've already did this morning, and that is a second file, which I have saved here called the Walmart data file. So essentially it's 6 years worth of standardized statements from Bloomberg that I've exported into this file. I've just saved it and named it Walmart data. Okay. So this is the exported historical data. Next thing I've done is I've taken this data, selected it, copied it, gone to the first tab of our valuation model, selected the tab, Pay Special Values. I'm actually not copy pasting because it's already here. Pay Special the values, and basically all that data is now the first tab of the model. And by the way, that's how we will update the model. So for example, if I were to use CVS, I do the same process, select the tab, copy, paste special values, the CVS data and over this tab. And since it row for row overwrites it, all of this data would be the CVS data, right? But right now, we're going to build a model based on historical Walmart. This is actual results, and I'm using 6 historical years, right? Previous years are on the left, more current years are on the right. So it goes left to right. All right. So from this model data, we then, or I did for you, have created standardized income statements. So this is a standardized income statement that we will use based on these fields. Okay. And so I've created my own mapping to create a standardized income statement. And then we've created a standardized balance sheet. Okay. So again, these data is standardized for you. And more importantly, you can see the references go back to the model data. So for example, 2015 revenue is coming from model C6. That's also why it's very important that when we create this file has to be created in a very specific way so that we always know that 2015 revenue will be in cell C6. Because if it's not in that C6, then it's going to cause us a problem. Okay. So using relative references, this becomes the recreated income statement, recreated balance sheet. Okay. And as a bonus for you post midterm, these have been mapped to the economic statements. So this is the converted TFI with the references to the balance sheet. This is the converted and balancing TII, and this is the CFI that comes out of that. So 6 years of TFI, 6 years of TII, 5 years of CFI, all automatically balanced based on standardized statements, the income statement balance sheet based on the standardized data that we're exporting from Bloomberg. And the EP based on the BOI and the EP based on the EOI. Those are the other tabs. Right? The other automated tab that the model creates is the ROIC tree. And that's under a tab called the ROIC drivers. So the tree that we used for the group project last week, those were created based on this model. So this model, anytime you load in historical data, will automatically generate this historical tree for the companies. Okay, so we'll have that as well. Right? So all of that is just reorganizing the past. Right? Does that make sense? Questions about this? Okay. So the other 2 tabs that matter are ratios and assumptions. Okay. So I'll start out with assumptions. As we build a valuation model, we are going to make some assumptions that we're going to use to create the future. And you'll notice on this tab in the spreadsheet, my assumptions are in yellow. Okay. One of the best practices that the book talks about when you build a model is that it's very important that when you change the model, you know what you're changing. You know what you can change, you know what you don't want to change because you don't want to break your model accidentally. So we are going to use a color. I've chosen yellow. You can use a different color if you want, but to highlight, these are cells that I know that I can change and will be changing when I do the future. So for example, if the last reported year is 2019 or 2020 or 2021, I can change it here and it will work its way through the model. If I have a different WAC, I change it here, it works it through the model. So these are assumptions that are universal that change the model. The other best practice is you want to limit the amount of places where you put these changeable assumptions. Because when you're building a reusable model, you don't want to have assumptions scattered throughout every single tab, because realistically, you'll just forget to change something. And then you'll wonder like why your model looks screwed up. So minimize the places where you change your assumptions all on one tab and highlight what assumptions you can change versus formulas. In this case, we're going to use the color yellow to highlight that. If it's not yellow, we don't want to change it because we'll probably break our model because it's probably a calculation or a reference sum. The other tab which we're going to change on is something called the ratios. So the next step that we are about to do, and you're going to be following me, is we're going to build a valuation based on the future. So this is now historical data. And so to create the future cash flows, we have to create the future income statements and balance sheets. And to create the future income statements and balance sheets, again, is a best practice. Instead of forecasting the numbers directly, we're going to forecast the ratios. And then once we forecast the ratios will create the statements, right? And that is just a better method of forecasting, okay? And that is what we are about to do. So the first homework assignment, which will be due next Monday, is to basically recreate everything we do here in class for about the next 45 minutes. And if you're able to do that, you can submit your homework and you're done. You don't have to do anything else between now and Monday as far as that homework is concerned. If you don't finish what we're about to do in class, then you have between now and next Monday at 10 a.m. to finish that. And then we'll pick up from here next Monday in the valuation. But the step that we're going to complete today, and which you're going to complete along with me and submit to show that you've matched this individually, so you cannot share spreadsheets, you have to do this yourself, basically is to create a forecast of the income statements and balance sheets and the corresponding statements of 6 years. Okay. And I'm arbitrarily picking 6 years of forecast. They could have done 10, could have done 5, could have done 11. I'm doing 6. Okay. So here's where we'll begin. So the first thing I'd recommend is saving your file and save frequently, because it would really suck if you're doing what I'm doing and then your computer crashes. So this is section 101. And now you should be typing and following along and doing what I'm doing. Make it a little bit bigger just so you can clearly see. All right, so the first thing I'm going to do is I'm going to label that we're going to create a forecast. And I'm going to use relative references. So my first forecast year is previous year plus 1. Again, I don't want to hard code 2021 as my first year forecast, because if I do and I change the model, then I might forget to change the year. So again, we're using relative references. Now, the first thing we're going to do is we're going to create a forecast for the income statement. These are the major income statement ratios that we are going to forecast, right? So the first one, just as an example, is we're going to forecast the revenue growth rate for 2021. As a placeholder for grading purposes and just for a model, we're going to start out by saying everything equals the previous year. Okay. So we'll later put in a more realistic revenue growth rate, but for right now, we're going to use last year's growth rate as next year's growth rate. And because this is a cell that I'm going to eventually change, I'm also going to make this cell yellow. So that highlights to me that that's a growth rate that I could change. Okay. Now, just to give you a preview of what we're about to do, I'm then going to go to my income statement tab. And I'm also on the income statement, again, make this a little bit bigger. I'm going to go to forecast. Previous year plus 1 for the first year. So this will be for the year 2021. Now, how do I forecast Walmart's revenue for 2021? Well, what I'm going to do is I'm going to say, okay, the revenue for 2021 equals the revenue for 2020. So equals G3. And I'm going to multiply it by left paren 1 plus the revenue growth rate. And the growth rate is on the assumptions, the ratios, cell H3, 1.9%, right paren. So here's the point. If Walmart were to grow another 1.9% approximately, then its revenue would be 533,700.6. Okay? So this starts to give you an idea of how we're going to build the income statements. The ratios create the numbers, change the ratios, change your numbers, right? So for example, and don't do this, but later, let's say I think Walmart's actually going to grow 3% this year. I put in 3. I go to income. Now the revenue would be a 3% growth, 539,682. But we're not going to change those yet. That will be later once we build the model. As we're just building the models, we're use placeholders just so we all know we have the same working model. And the placeholder we're going to use right now is equals the previous year. So that should be the 1.9%. Okay. So continuing on, I need to forecast the other income statement items. Now I'm going to do a little shortcut that will save you some time, right? Because the next item we'd have to forecast is cost of revenue and then operating expenses to get to our EBITDA, right? Now, in the real world, we would forecast cost of revenue and we'd forecast operating expenses because that granularity is important. But for purposes of the model doesn't care because what the model is going to use is the EBITDA. So to save a little time, rather than forecasting these two numbers to get to EBITDA, we're going to forecast the EBITDA directly. Okay. So in this case, EBITDA equals the previous year. And I'm going to make that yellow. Okay. Then I have to forecast depreciation and amortization as a percentage of sales. And again, right now it's a placeholder. I'm going to make that equal the previous year. And that's going to also be a cell that I could change. And by the way, when I do that, I'm going to solve for an operating income equals the EBITDA minus the depreciation and amortization. Notice that cell's not yellow because this cell is dependent on the two above. EBITDA minus DA equals operating income. So that's the point. Well, I'm choosing to forecast as EBITDA. And then from the EBITDA forecast, it creates a forecast for EBIT or operating income. Because I forecast EBITDA, forecast depreciation, creates this. I want to forecast these three separately because this minus this equals that. Now I could have forecasted the depreciation and the operating income and work backwards to solve for EBITDA. It's another way to do this, but my preference is forecast EBITDA, forecast DA, solve for operating income. Again, if you have questions about this, let me know as we're going along. All right. For the tax rate, we're going to need a tax rate for Walmart next year. Again, as a placeholder, I'm going to use last year's tax rate. And again, that's going to be something that we change. I'm going to make that yellow. Then I'm going to solve for a no plat. By the way, if you want to see what the formula is, you can also go to cell G11. That's going to be an H11. Basically, it is the operating income times left paren 1 minus that tax rate. Can't select that cell, and I don't know why. All right, I'm going to try this again. 1 minus. I want to take, I don't know, it's supposed to be H10. Do it manually. You can copy it over here. I don't know why I'm having trouble doing that. But you can basically just copy G11 to H11. But essentially, that's solve for so you don't make that yellow. And the net non-operating gains and losses equal the previous year, and that will be yellow. It's percentage of sales. So all of these numbers, by the way, are a percentage of sales with the one exception that revenue growth rate is a percentage change. Okay. Now, since this is the income statement, and I told you I want 6 years, I'm going to copy and paste this out to column M. So now I have ratios forecasted out through 2026. And again, they're all just placeholders equaling the previous year again and again and again. Right? So the next step is I'm going to go to the income tab and I'm going to finish building my income statement. Right? So the first item that I forecast here is jumping all the way down to Ebitda. Right? So we're going to forecast the Ebitda directly rather than the intermediate items. Okay? So in this case, what I'm going to do is I'm going to take, to get Ebitda in dollars, I take revenue for 2021, which is H3, and I multiply by my ratios, Ebitda as a percentage of sales, which is H7. And that would give me 32,141.4 million of Ebitda. Okay, so revenue times ratios, Ebitda is a percentage of revenue. Next, go back to my income statement. I need to do depreciation and amortization in dollars. So again, equals 2021 revenue, H3, times ratios, 2021 depreciation and amortization as a percentage of revenue, H8. So 11,191.2. Solve for operating income equals Ebitda minus the depreciation gives me an operating income of 20,950.2 million. Okay. So very quickly, we have forecasted an operating income / EBIT for Walmart for 2021. Right. Next, we have to forecast those next 5 line items. You'll notice I didn't put those in the ratios tab, right? 2 reasons. One, doesn't really matter to the valuation. You're going to start to see that when we build the valuation model. They don't affect the valuation. But number 2, so for window dressing, we're going to make some simplistic assumptions on these. And one of the simplistic assumptions we're going to make is that Modigliani Miller, according to the book, again, when you're doing the enterprise DCF valuation, says that you should use a target capital model. And so if you have a target capital model, you're not really changing the debt to equity balance. Our simplistic interpretation of that means we're going to leave the debt alone in the valuation. So if we're leaving the debt alone, then whatever interest payments they're making, they're going to still have the same interest expense. So as a placeholder equals the previous year, right? Same thing with interest income. Whatever interest income we're going to leave alone equal the previous year. Now, if you wanted to forecast an actual interest expense based on the balance sheet, figure out a yield, and an interest income based on the income statement and figure out a yield, you're welcome to do that. Won't have really much of an effect in the valuation, but nonetheless, we're going to use these as placeholders. Foreign exchange gains and losses, 0. I don't know what's going to happen to exchange rates in the future. So therefore, I'm not going to forecast the gains and losses. Assume the company is able to hedge effectively over time. Income and loss from affiliates, whatever they're gaining or losing, I'm going to leave equals the previous year. And non-operating income or losses, that was an income statement assumption ratio. So equals 2021 revenue times from the ratios tab, 2021 non-operating gains and losses as a percentage of revenue. Pre-tax income is basically, you can see what's happening here, operating income minus this, plus this, minus this, minus this, minus this. Or very simplistically, you could take cell G16, copy it, and make it cell H16, paste. For my income tax expense, if that is my income, pre-tax income, I have to pay taxes on that. So equals my pre-tax income times assumptions, or sorry, ratios, my 2021 tax rate, which is H10. So if I pay $5,015.7 million in taxes, my income before extraordinary items equals the $20.5 billion of pre-tax income minus the income before the income tax expense, and I get income before extraordinary items of 15,512.6. Again, you can see the pluses and minuses that I'm following over here on the left. Extraordinary loss net of tax, 0. By definition, extraordinary items should not happen again. So if they're not happening again, we're not forecasting extraordinary items. Therefore, extraordinary items should be 0. Net income before minority interest equals the income before extraordinary items minus the extraordinary items. That should also be the 15,512.6. Whatever the minority interest dividend payments are, again, we're going to leave alone because we're not changing the capital structure. So equals the previous year. And that would get us an overall net income to common shareholders. Again, if you're lazy, you can copy cell G22 to H22, but it's basically the net income before minority interest minus the minority payments. 15,192.6. All right. Total cash preferred dividends, similar to debt. We're not going to change the equity just because we're not going to change the debt. Therefore, whatever dividends are paying, they're still going to pay. Equals 0. Yeah, sorry, equals the previous year. So H23 equals G23. Other adjustments to equity are 0. These are accounting adjustments as GAAP and is being changed by FASB. So the idea here is that because we don't know what those accounting changes are going to do in the future, when they're going to be implemented, we're not going to forecast them, and they generally don't affect cash flow anyways. So we're just going to leave those as zero. Net income available to common shareholders. Just to be easy, I'm going to take cell G25. I'm going to copy it. I'm going to paste it. I'm going to solve for H25, which is basically the way you get from 22 to 25. So that's my net income available to common shareholders after dividends, preferred dividends. Common dividends equal the previous year. We're going to leave the dividends alone, 6048. And basically income minus dividends equals change in retained earnings. But here's the trick. Over here, I would normally subtract from the net income the dividends paid, and what's left gives me retained earnings. But this is a quirk that we also have to be aware of every time you do a model. Bloomberg gives us dividends as a negative number. Bloomberg gives us expenses as a positive number. Okay, it's just their way their database works. So on the income statement, expenses are positive numbers. On the cash flow statement, dividends are a negative number. Right? So we have to deal with the data that we have. So normally I would subtract the dividends from the common shareholders net income. But the problem is if I subtract a negative, I'm actually adding it and I get the wrong change in retained earnings. So in this case, even though it says minus the dividends, equals net income plus the negative dividend, equals net income plus the negative dividend. And that is my change in retained earnings, 9144.6. And that's just due to the data feed. So I know Bloomberg is always going to give me a negative number. Therefore, I can use this. This is also why the model that you're building is tied to Bloomberg. If you were to try and use another data source, you'd have to remap everything and make sure the signs work correctly in all of your model. The flip side is because we are using Bloomberg, every time we export from Bloomberg and we know it's going to give us data in this format, it actually makes the model very reusable. So just a very important quirky tip to realize every time you build the model. Somebody asked me in the chat, can you go over pre-tax income to minority interest again? So the short version is to get from pre-tax income minus the income tax. And so for the income tax expense, it's basically the pre-tax income times ratios H10, which is the tax rate. Okay. And that would get you an income before extraordinary items. That's the 15512.6. So basically H16 minus H17 equals H18. Okay. Now, once you get to H18, we're saying for extraordinary loss net of tax, we're making that a zero because we're saying that extraordinary items by definition shouldn't happen again. So therefore, we don't know any extraordinary events, can't predict the future with a crystal ball. Therefore, there shouldn't be any extraordinary items in the future. Therefore, we're not forecasting them. Zero. Now, again, anything I'm putting in here for a zero or anything I don't change, if you felt was important to change, you can always go back and change. But for 95% of the time, you're not going to need to do that. So I'm trying to save us a little bit of time here in the model. So what's window dressing and what's important? So by the way, take the income before extraordinary items minus the zero, and you basically get net income before minority interest. H18 minus 19. Then same thing for minority interest. Whatever dividends we're paying, since we're not changing the cap structure, we're leaving the dividends alone. So if we paid $320 million in dividends last year to the minority shareholders, we're going to pay $320 million this year to the minority shareholders, giving us net income, the 15192.6. So this minus this equals that. Right. And then when we get all the way down here and change retained earnings, we've now solved for the 2021 income statement. Your final step is to take column H, copy that whole column, select, and paste it through column M. And if you did it correctly, you should now have 5 years, additional years, 6 total of forecasted income statements going from 2021 to 2026 for Walmart. That's also assuming these ratios come true. And here's our final step for the income statement. We got to eventually map this to the TII. So we go to the TII, and the TII, which is relative references. So we can take column G, we can copy column G and let's start copying from here to here. Copy from G3 or G2 to G19 at column G and paste it to column M. And this is my forecast. Just copy this over. In case you're wondering why I'm writing the word forecast and copying it over, it's just if I look at my data in the future of the model, I want to know what's real and what's a guess. Basically, I want to know what's my past and what's my future. So that's why I'm putting the word forecast on the future, just so I know when I'm looking at a column, I'm not looking at historical data. But the point is, because I've already mapped this for you with relative references, when you copy over column G to column M, then you get balancing TIIs going through 2026. Took about 20 minutes. We now have a forecasted and balancing income statement in TII. Now we're going to go do the balance sheet. Questions about the TII? How we got here?
I actually had a question about the income statement we did.
Yep.
So for the pre-tax income, I'm not getting the same number as you.
For which year? This one?
For 2021, yeah, the first year that we forecast.
How far off are you?
I'm about 400. No, I'm about like 400 less than you.
Okay. What numbers above or below start to look different?
So all the numbers above looks the same, and the only number that's starting from pre-tax income, it starts to look different, and then the one below it, income tax expense, looks different, and then obviously income before XO items also are different.
All right. So here's the thing: are you using this formula H3 times
H3 times ratio H12.
Okay. And here's just a question on your H12 on the ratios.
Yes.
H3. Do you have equals G3 or did you actually type in 1.9%?
I have equals G3. This I have the same as you. Like I did it the same way you did it.
Then that one I can't explain. I don't know why it's different. You could send it to me after the class or something. I could take a look at.
I think if you so basically what I did to like expand it, I did like the shortcut in Excel where you highlight it and then you drag it across. I think if you had if you typed in 0 in one of the columns, it might have filled it into 1, 2, 3, 4, 5, 6, and that might be where the issue is.
Well, I will say that, and I didn't mention it during this class, but I strongly caution people against drag and drop for the reason that you just mentioned, even if that's not what happened here, because what they're saying is if you were to take this and drag and drop every now and then, Microsoft trying to be your friend, I'm going to undo this, instead of just saying, oh, it's just zeros, will actually say, oh, it's a series. And then suddenly it'll be 1, 2, 3, 4, 5. And it'll basically create a series without telling you. And then what'll happen is they'll screw up your model. Your model will be off and you won't know why. And that could be one of the reasons why. I'm not saying that's what happened here, but that's also why you should never drag and drop. You'll always notice when I'm building the model, copy paste, or particularly copy paste special values. I don't drag and drop.
Okay. So I actually figured out why the number was different. It was actually because the same reason that you just mentioned. So I went back to the ratios. So instead of dragging it, I just copied and pasted instead.
So that's again just another minor thing, but just yes, don't drag and drop.
Okay.
As I said, because Microsoft does not warn you when it tries to help you. Like if Microsoft warned you and said, hey, I'm going to put this here, is that okay? That's one thing, but they don't do that. They just change the numbers and you don't even realize that they made a change and that could cause problems. So there's a good example of that. Thanks for catching that. All right, let's go on to the balance sheet.
Can you go over the TFI one more time, please?
TII?
Yes.
Basically just copy column G to column M. That's all you got to do. Select it, copy it, paste it to column M. Now what I did is I just did G2 to G19 so it wouldn't have the word history and I had to replace it. Because if you copied column G and total to column M, paste, it was a history and you had to change the history. I was being lazy. So I copied here and then just add the word forecast and copied. But either way, this data has to be copied for 6 years. And it should balance check should be 0 because this is mapped and it's mapped to the statements that, so if I have a balancing balance sheet, should have a balance, as a balance, the income statement, I should have a balancing TII. All right, create the balance sheet. Ratios. These are the balance sheet ratios. Actually, these balance sheet ratios are all a percentage of sales. Okay, so this is where we'll differ from the book in that, and there'll be 2 reasons. You'll see this later, but this will actually benefit you. That normally you do ratio on the balance sheet tied to the driver and the income statement. But for simplicity, we're going to do all the balance sheet ratios as a percentage of sales. Therefore, when you change sales, it changes the entire balance sheet. Actually makes our life a little bit easier. So that's how we're going to measure productivity. Anyways, so translation. For right now, for cell H14, which is accounts and notes receivables, a percentage of sales, equals the previous year. So equals G14. Make that yellow. And then we're going to copy cell H14 all the way down to M, that is M24, and paste. So basically what we're just saying is for the balance sheet ratios for 21 to 26, everything equals the same percentage of sales going back through 2024. Okay. All right. Now, actually, this number is the one number that will change over time because it's actually not a ratio and we're solving for that. So for purposes of this one, I'm going to wipe those out. Leave it yellow, but wipe that out. All right. Now, balance sheet. We're going to create, again, I'll make it a little bit bigger, from these ratios, a forecasted balance sheet. And my first year is equal to previous year plus 1, so 2021. All right, so basically, since these are a percentage of sales, I'll start out and create all of these as a percentage of sales. We're about to do the same process 11 different times. The first one is accounts receivable. So I go to my balance sheet, 2021 accounts receivable, which is cell H6, and I say equals, do it this way, ratios, the 2021 accounts receivables percentage of revenue, so that's H14, times income tab, 2021 revenue, H3, which would equal 6,400.8. Right? Do this again. Next ratio is inventory. So for H8, which is inventory, equals from the ratios, inventory is a percentage of sales, which is H16, times income 2021 revenue, which is H3. I actually skipped the unbilled revenue. So for unbilled revenue, which is H7, skip this one, equals from the ratios, unbilled revenue as a percentage of sales, which is H15, times income H3. So I'm just basically taking the item as a percentage of sales, multiplying by the forecasted sales to get the item. Again, other current assets is a percentage of sales. So for H9, I go to the ratios as a percentage of sales. It is H17 times income H21. Next one is, I believe, which ratio do next? Long-term investments. So on the balance sheet, long-term investments in receivables equals from the ratios, long-term investments in receivables, which are 0, times income 2021. You might say, well, gee, why are we forecasting a 0 And the answer is because this is a reusable model. May not be zero for another company. Net fixed assets as a percentage of revenue equals, so for H12 for the ratios.
Sorry, I don't mean to interrupt. Could we go to, was it other current assets, I think, one more time? The ratio H3 times income H21, is that incorrect? It's right
So H3,
H3,
so H times H17.
oh, times 8. So not H21, H17. Okay.
It's H17.
Oh, I still don't get the right answer. That's really weird.
So ratio is H17 times income H3. And ratio is H17 should be the other current assets as a percentage of sales.
Now I got it. Thank you.
Great. And I was doing net fixed assets as a percentage of sales, same process, right, as you were asking that question. So that would have been H19 times income H3. Next one's long-term assets as a percentage of sales. So equals, and just be careful as you're doing this because there's a lot of cells that are close together. It's easy to click on the wrong one. H20 times income H3. And then we go to accounts payable would be the next one, is percentage of sales. For H19, it would be the ratios H21 times income H3. So 68.8 billion. Other short-term liabilities equals from the ratios H22 times income H3. And finally, we have other long-term liabilities equals ratios H23 times income H3. So those are basically the 10 that we're forecasting out of the 11 of these balance sheet items, all created in dollars by taking the percentage of sales times the forecasted sales to get the dollars. Okay, so again, those ratios create the balance sheet items. Now, what we need to do is we have to finish off the balance sheet, get the balance sheet to balance, and most importantly, not create a circular reference in the process. If you ever run across a model with a circular reference, it's an invalid model. All right. And so in this class, an invalid model will not be graded. Right. So you cannot have circular references in your models. So I'm going to show you how to finish off this balance sheet without a circular reference. And we're going to start by doing the liabilities and equity first. Okay. So let's start with equity. Right? So in this case, total preferred equity, right? For 2021, H28 equals the previous year. And again, the idea is we're not messing with the cap structure. We're assuming the cap structure is the target cap structure. And we're not going to change the debt or equity in our valuation. So therefore, whatever preferred equity they have, they keep equal the previous year. The same thing is true with minority interest. Whatever minority interest they have, they keep. So this is the minority interest stakes they have in the balance sheet, equal the previous year. So H29 equals G29. Share capital. We're not issuing shares. We're not buying back shares. So whatever share capital they have at common stock at par equals the previous year. So equals G30. And then for retained earnings, we have to solve for the 2021 retained earnings. So here's how we solve for the retained earnings. For 2021, we take, so cell H31 equals, we take last year's retained earnings, which is G31, and we add from the income tab, H27, which is the change in retained earnings after dividends have been paid from the income statement. So H27. And so our retained earnings for next year would be 80 billion to 82.6. And if I sum these four items up, I get my total equity from my balance sheet of 96.6. billion. Okay. Then we're going to forecast the liabilities. We'll start with the current liabilities. The missing current liability is short-term borrowings. Since we're not messing with the capital structure, we're going to leave whatever short-term debt is alone, equals the previous year's short-term debt. Therefore, I can solve for my current liabilities, equals the sum of the three above. 79,082.4. Long-term borrowings. This is interest-bearing long-term debt, equals the previous year. Again, we're not changing the long-term debt. We're leaving it alone, 64,192. Pension liabilities equal the previous year, right? Companies are not allowed to unfund their pensions long-term anymore. So therefore, if they have a pension liability, they're going to keep it. And if they don't have it, we're not going to grow it. So equal the previous year. Sum the three above to get our total long-term liabilities, which are the long-term borrowings, the other long-term liabilities, and the pension. And that gets me my total long-term liabilities of 77,393.8. If I add my current liabilities, 79,082.4, to the long-term liabilities, the 77,393.8, I get total liabilities of 156,476.3. And if I add the total liabilities, the 156,476.3, to the total equity of 9696.6, I get total liabilities and equity of 247,172.8. So very quickly, we have forecasted the liabilities and equity side of the balance sheet. It is also important to get a balancing balance sheet. So I'm going to show you the trick to get a balancing balance sheet. Take your total assets, which is 816, equals total liabilities and equity. You'll be surprised by doing it this way, your balance sheet will balance every time. What this sets up in order to make it actually balance is the assets have to add up. So something on the asset side needs to become a plug, which means we're going to solve for something that makes the assets add up.
Professor,
Plug is going to be excess cash. Yes.
sorry to interrupt, but can you do the equation for total assets again?
It simply equals total liabilities and equity. So equals 833.
Oh, okay. Thank you.
And that's what I'm saying. Because we're basically forcing it to balance, we need a plug to add up all the assets to equal it. And the plug is going to be excess cash. Okay. So now we got to solve for the rest so that we can plug excess cash. Well, the next one we need is operating cash. Operating cash is on the assumptions tab. And the reason I put the operating cash in the assumptions tab, not the ratios tab, is the primary difference between the two tabs, the way I'm setting up the model, is the ratios are things that can change year by year. The assumptions never change. So if we make an assumption, we're going to always use that assumption. That's the philosophy I have between the two tabs. So operating cash as a percentage of revenue, we're always going to leave at whatever percent. We're not going to change it year by year. So in this case, I got a placeholder for 2%, which is B3. So what we're going to do is on the balance sheet, we're going to take for 2021 operating cash, which is H4, we're going to say equals ratios, or sorry, assumptions, B3, operating cash as a percentage of revenue, times income, H3, 533,700.6, which gives us 10,674 of operating cash. Now, when I copy this over, it's going to cause a little bit of a problem because when I copy this over to the next 5 cells, B3 is going to become C3, D3, E3, F3. And I don't have it year by year. I only have 1 year. So what I'm going to do is I'm going to take this formula and assumptions B3 and edit it. And I'm going to put a $ in front of the B and a $ in front of the 3. And that tells Excel to make it an absolute reference to cell B3. That means whenever I copy that cell anywhere in Excel, it's not going to change the reference. It'll always use B3 as the reference. All right. Final one we have to do is we need goodwill. Goodwill comes from future acquisitions. Well, nobody can predict what the future acquisitions are going to be, much less the price of those acquisitions. So whatever goodwill we have, we leave alone. Even if goodwill were impaired, it's a non-cash, non-tax impacting item. It's just an exercise in futility that the accountants do anyways. So leave goodwill alone. Doesn't really matter to us if it changes. So 31,073. Okay. So now we just have to start summing things up, right? And plug. But before we do, the last item we would need is excess cash. So here's how we plug excess cash. What we do is for cell H5, say equals the total assets, which is H16 minus everything else. So minus operating cash, which is H4, minus accounts receivable, which is H6, minus unbilled revenue, which is H7, minus inventory, which is H8, minus other current assets, H9, minus long-term investments, which is H11, minus net fixed assets, which is H12, minus goodwill, which is H13, and minus other long-term assets, which is H14. So we're basically subtracting everything else from the assets. So what's left would be our excess cash, 5827.4. Okay. And then we can sum up our current assets. Equals sum of everything from H4 to H9. We can also sum our long-term assets, equals sum from H11 to H14. And if I just wanted to check my work, I add my current assets to my long-term assets, and that should be the total assets, the 247, 172.8. So my plug worked, and notice no circular reference. If you get a circular reference doing this, you screwed up. You have to go back and fix it. So that's the point. I've shown you how to do this without a circular reference.
Can you go over the goodwill again, please? Is it just equal to the previous year?
Equal to the previous year, because we don't know what the acquisitions are going to be. So we're just, and goodwill is only impaired. So we don't change it unless it's impaired and just leave it alone. And even if it's impaired, it doesn't affect any cash. It's just a write-off of equity that has no tax impact. So even if it is off a little bit in the future, who cares? Doesn't affect the valuation. It's just window dressing to get a balance sheet to balance. 31,073, equal previous year. All right, getting near the end. Take column H, select it, copy it, select all the way to column M, paste it. We now have 6 years, 5 additional of balancing balance sheets based on those ratios. Once we do that, go to your TFI. I'll do it the other way this time. Take column G, select column G, copy it, go to column M, paste it. We now have 6 forecasted TFIs. So cell H1, flip it around, call that a forecast. Copy the word forecast to cell M, just so you know that that's not history. But again, I now have 6 years of balancing TFI based on those balance sheets. Then I go to my CFI. Because I have TIIs and TFIs, I can take column G, copy it, go to column M, paste it. I now have 6 years of forecasted, change the word to forecast, and balancing CFIs. I then go to my economic profit for 2020. I select 2020. I go to column M. I paste it. I now have 6 years of forecast, change the word, forecasted and balancing economic profits based on beginning of year equity. And if I go to my EPEOY tab, which is the economic profit based on end of year equity, column G, copy, column M, paste. I have EPEOY forecast going 6 years through 2026, that balance. Save, done. That is your next homework assignment. So if you reach this point, and you can check that you've reached this point pretty much by looking at the CFI. And if you got 80773 for the final forecast year of Walmart CFI, then you probably have the right answer. That's actually how the TAs are going to grade you, because there's no way you get to this number unless everything else doesn't balance. So if it balances, you get to 80773, then you know you did it right. Okay. And so basically, this is the model, and all the statement years had to be copied over, that we are going to start with next Monday and continue and turn it into a valuation. Because what we've done so far is we've set up a forecast of the statements, put them in economic format, got the cash flows. Next, what we're going to add on to this model is the actual valuation. Okay. So you need to submit this model as is, individually, no copying or sharing. Like, you had to do this yourself, and you have to submit this balance sheet by Monday morning, 10 a.m. Okay. And as I said, we're going to use this model that you built. I'm not going to give you a solution, so you have to do it yourself to keep going. So you need to get to this point yourself by next Monday. Otherwise, you won't be able to complete the next homework assignment, because the next homework assignment is going to build on what we just did here today. You have to get to this point.
Excuse me, I don't mean to interrupt one more time. Can you go to the TFI slide? I'm sorry.
Yes. And somebody mentioned in the chat that the homework 7 isn't open yet, and I need to open it, and I'll open it shortly. As soon as we end this class, it'll be my next step, is to open up homework 7 so you can submit. Okay. Any other questions?
Yeah. So when you copy like the column, you do paste special, right?
No, you just copy paste columns.
Okay. Because
the time to use paste special is primarily when you go across worksheets. Because if you copy and paste from, for example, this file to this file, and you just copy it, Excel might set up a link between the two files so that every time you open up this file, it's looking for that file, right? And you don't want that to ever happen to your model, all right? So if I'm copying data, and that's all I want is data across models, copy, paste special values, just give me the data. I don't want the links. I don't want the formats. I just want the data, all right?
Okay.
And then sometimes in my model, I might just want to move data from one tab to another, copy the data, paste special values. Because if you copy paste, it copies the formulas. So that's when you paste special values. But otherwise, when I'm just moving formulas across columns, I copy paste because I want the formulas to come with me.
Okay.
Okay. Other questions? All right. So as I said, I'm going to open up, do it right now while we're talking, homework 7. So make sure you submit that file by Monday, 10 a.m., basically, 15-minute deadline. Remember, on Monday, 2 things are going to happen. We are going to pick up from here, and we'll continue the valuation. We'll actually do the valuation of Walmart on Monday. And we'll do it. It'll be a shortened class because by noon, we'll then flip over to the Zoom for the CFO of Aetna will be our special guest. So please be on good behavior when they're here. And as I said, if Team 6 wants to be one of the presenters for both extra credit and to represent the school and redo your EIC presentation, let me know, because I'm going to, like I said, try and organize 3 teams across the classes to present to the Aetna CFO and have a little Q&A that day. But otherwise, go ahead.
So I just went, so you said we can just submit what we just did in class for homework 7, right?
Yes.
So I just went to the page and I like refreshed it a bunch of times and it.
I was about to do that. I have to turn.
Oh, I saw that and I thought you did.
I haven't done it. No, I stopped it while we're talking.
Okay, sorry. I thought you did it, so I just wanted to let you know.
Coming really soon.
Sorry about that.
I'm not that quick. I like to be not that quick. Give me about 4 minutes.
Okay.
But otherwise, that should end the class today. And again, if Team 6 wants to chat, I'm still around. Otherwise, we'll let everybody go.
When we, all right, never mind.
Thanks, Professor.
Okay, have a good day, everybody.
Take care.